Hello and welcome to a brand new episode of Market Sense powered by ETMarkets. Well, it is a show which talks about market trends, economy, sectors, investment strategies, as well as some candid conversations as well. Well, my name is Kshitij Anand and today we have with us a very special guest, Rupen Rajguru, who is Head of Equity Investments and Strategy at Julius Baer India. Well, Rupen has more than 2 decades of experience in Indian capital market, and prior to this, he was with HDFC Bank as well as Citibank. Well, welcome to the show, Rupen.
Thank you. Thank you very much, Kshitij. Pleasure to be here.
Well, Rupen, let me just quickly go down to the boiling question at this point in time, that is FIIs. They've been marked sellers in Indian markets for the past 6 months, and this will be the 7th month in a row. Now, selling pressure seems to be on the rise in April as well. So what is driving FIIs away from D Street, and will they come back in near future? What are your views on that?
So, Kshitij, the way one has to look into the FII or FPI flows,
Sure.
We have to look what FPI stock is there in the Indian market and what are the flows. So it is stock versus flow.
Okay.
So as of December 2021, the FPIs collectively held roughly 20% of the entire market cap of the top 500 companies. So if I were to, extrapolate, if the Indian total market cap is at $3.5 trillion, so 20% would be upwards of $650-700 billion. So there we have seen say $25-30 billion of sale. So in that context, it is say probably around 5% sale is what we have seen. While definitely that sale is pretty huge in if I were to look into isolation, but at overall 5%, and we have to also see the context. In last 6-7 months, wherein the FII sales have just accelerated significantly, we have to see it in 2 contexts. In the latter half of last calendar year, I mean, post all the incidents which we saw in China, overall there was huge amount of outflows which happened in a lot of the funds which track the MSCI Emerging Market Index, and China is, as we speak, it is 30% of the entire index. A year or year and a half back, it was roughly 40% of the index. So if somebody is negative on China, the entire EM gets impacted.
Right.
So India, which is currently 10 to 12% of the EM basket, so India, the flows were in India as well. Secondly, in this beginning of this calendar year, the fears of the US rate hikes, and which has actually fructified as well, that also led to a bit of FPI selling. The sum and substance of that, what I'm trying to get into is that, yes, FPI selling has been there, and there are reasons, and some amount of profit booking FPIs have done in India as well, because India has been a huge outperformer as far as EMs are concerned.
Right.
But ultimately, what will happen is that liquidity will flow where there is growth. Right. So if I were to look through India as a country, is one of the few countries globally which is going to grow much higher than any other country, including China, as well as the profitability growth of India is going to be pretty strong. So difficult to pinpoint when, but we believe that ultimately FPI's flow will come back into Indian markets.
Right. Well, that's a positive sign. Now, let me quickly go to another pertinent questions. And, you have over 2 decades or 20 years of experience under your belt. So what do you make of the equity markets? We have seen some record printing from global central banks, war situation in Russia as well as Ukraine, as well as inflation, which will lead to high interest rates in the future. Now, all these things do point some worry to equity markets, not just for India, but across the globe. So what are your views on that? And what does history suggest as well?
So it's a pretty interesting question, Kshitij. And, let me tell you, this pressing question will be there at all points of time, because at all points of time, there would be 5 reasons for why we should be bearish on the market and 5 reasons why we should be bullish on the market.
True.
Having said that, ultimately there are 3 things which determine where the markets will head. Liquidity, then there is ultimately sentiment, and finally the fundamentals. So liquidity and sentiments, these two determine what's the short-term market movement. So all those factors which you mentioned and more about, be it war or be it some uncertainty, no China related the shutdown and in a half, like 30% of China is right now shut as we speak. So all those will impact the short-term sentiment of the market. Okay, and liquidity and sentiments are linked, so that will have a short-term impact on the market. But let me tell you, it changes very fast. Right, a month back we all were concerned, and the war is still going on, but the markets are much higher than what it was when the war began. Right, so these factors are difficult to predict, but ultimately the market direction. And if I were to come more from an Indian standpoint, we look into how the fundamentals will pan out.
Sure.
So here, Kshitij, what we believe that after almost a decade, India is now entering, or in the corporates, India is entering into an earnings growth era, and the earnings growth will now be more than the nominal GDP growth. So, in fact, between 2010 and 2020, in that decade, the earnings growth of India in totality was lower than the nominal GDP growth, and there were reasons for it. And now, probably, we believe it will revert back to mean. And in fact, to revert back to mean, initially for first few years the earnings growth will be higher than the nominal GDP growth. Right. So in that context, I think from an Indian market standpoint, at least for next few years, we are on a very strong wicket. There will always be short-term movements, and while we try to channelize a lot of our energy in figuring out what's going to happen in the short term, and which I think we all know it's very difficult to predict. True. If the fundamentals are strong, I think in next 2 to 3 years, I believe the Indian markets will be higher than where they are as we speak.
Right. That's some positive guidance coming from Rupen. And let's talk about some sectors as well. We've seen a big hit from IT stocks taking a knock in the recent past. HDFC Bank merger also weighed on the sentiment. So what is market pricing in according to you?
So Kshitij, if I were to first talk about the IT sector, while yes, in the last 1 month or it has underperformed.
Yeah.
But if I were to just step back and rewind, in I think 2018, the valuation of the entire IT sector, probably it was at a 10-year low from its historical perspective. Large cap companies were available at around 15, 17 PE multiple. Mid caps were available at sub 10 PE multiple. Okay, and the overall growth of industry was at a single digit in a revenue dollar terms, or early mid to single digit, 5-6%.
Right.
Thereafter, things changed, and globally the trend of digital transformation and cloud migration kind of picked up significantly, and the earnings trajectory of these companies changed from 5-6% dollar revenue growth to mid-teens and to some even high teens growth.
Right.
So there has been a massive re-rating of the IT sector. And then coupled with that, I think a lot of the IT companies also announced buybacks. So that also helped in improving the overall ROE, which helped improve their valuations. So now, say come March 2022, the IT sector, which was in line with the market valuation, the PE of large caps from 15-16 in 2018 has moved up to 27, 28, and mid caps from sub 10 to as high as 30, 40, and some even 50. So mid cap stocks have gone up almost 5 to 10x, and large caps have gone up 3x odd in last 3-4 years. So after that, definitely there is we would believe that there would be some pause, because the margin pressure is there.
Yes.
And then I think, and I'm sure everyone, including us, are witnessing lack of talent, especially on the IT side, and the prices, the costs have gone up significantly. So while we are positive on the overall growth for the sector, but the margin definitely will be under pressure, and there is a bit of readjustment. So from the PE significant re-rating, it is kind of getting into more realistic valuations. So we are not too much concerned about that.